Good morning, everyone. My name is Prakash Mahto, Assistant Professor, Finance and Accounts with IIMT College of Management. Today, we are going to discuss the topic derivatives. So, first, we are supposed to understand how the derivative product originated. It was at Chicago commodity market somewhere around in the 19th century, somewhere around 1850. The farmers and traders used to buy and sell agriculture commodity products on Chicago commodity market. So the buyers were the traders, retail traders, and the seller were farmers. So supplier were the farmer, and farmer wanted to secure that their product should get sold at good price, and the buyer, that were traders, they wanted to assure that they should able to get enough commodity and enough supply that they should be able to meet their business commitment. So the buyers, that were retail traders of the commodity, they wanted to secure supply of the product, and farmers wanted to secure the selling of that product. That was customer. They wanted to secure their customer. So what happened that traders and farmers started getting into a contract called to-arrive contract. What was the to-arrive contract? That when the farmers were sowing their seed in the field, at that time only they were getting into contract with the traders that I will sell you, suppose take it 100 ton of wheat. I will sell you 100 ton of wheat after 3 months at the 500 rupee per ton. And buyer, they were the trader of the commodity product. They wanted to, they used to get into commitment that was, I am going to buy 100 ton of wheat after 3 months from you at the price of 500 rupee per ton. So they were getting in contract to secure the trade. Farmers used to secure their customer, and the traders used to secure their supplier. So actual trade is going after 3 months after harvesting of the wheat. But they are getting into contract in the beginning only when the wheat has been only shown in the field. So the actual trade will take place after 3 months, but they are getting into contract right now, and in that contract they were, so the buying or selling of this contract, which the actual trade will take after 3 months, was called forward contract. Okay. So this is the way derivative product started. So now coming to definition of derivatives. Derivatives is a financial instrument which value depends on or derived from underlying assets. See, why the name derivatives? Derivatives was named only because the contract itself were not having any value. That means that farmers and traders getting into contract that they will buy or farmers will sell and traders will buy the 100 ton of wheat at the rate of 500. The actual trade will take place after 3 months, and they are getting into contract now. So this contract which is going into, they are getting into, how they got the value of 500 rupee per ton on the basis of wheat that is going to be traded after 3 months. So the contract was not having itself any mechanism of getting coming to the price, but price was being defined on the basis of the price of the contract was being defined on the basis of the asset that is going to be exchanged on the after 3 months. So the price of this contract was being derived from the underlying assets. That is the wheat in our case, which is going to be traded after 3 months. So because we are deriving price from the underlying assets. That's why it is called derivatives. Similarly, take an example. Price of a stock future or for a stock future is derived from the current price of that stock in cash market. So, because the basis of the deriving of the price of the future contract of the stock, we are considering the price of the stock in cash market. So we are deriving price from the underlying asset. That's why it is called derivatives. Now, there are two types of markets in which derivatives are traded. One is OTC market, another is exchange traded market. OTC market is basically a network of investment bankers and dealers. There are big dealers into this financial market. So these dealers and investment bankers or any other intermediary, they are having one network, and through that network they fix the price and quantity of the product to be traded on the basis of the instruction they have got from their customer, their individual customers. So that market is mostly unregulated and unstructured. So that market is called OTC market, over the counter market. And then another is exchange traded market. Suppose we are buying or selling product on the National Stock Exchange or Bombay Stock Exchange or Chicago Stock Exchange, then it is exchange traded. And exchange traded trades are very rigorously regulated, and all the terms and conditions is defined by the exchange. So these are the two kind of markets where derivative products are traded. Then there are four types of derivative products available in the market. One is forward contract, another is future contracts, third is option, and fourth is swaps. We will go through the concept of forward contract and future contract today. Options and swaps will be taken in next session. So what is the forward contract? The contract that we have discussed on the Chicago commodity market, the farmers and traders getting into contract, that is the forward contract. Why forward contract? Because the actual trade will take place after 3 months, and right now we are getting into agreement of, or we are trading right now, the actual exchange of the goods and this currency will take place after 3 months. So it is an agreement to buy or sell an asset at a certain future point of time for a certain price. This is forward contract. And in contrast to a spot market contract, which is an agreement to buy or sell an asset today, in forward contract, we get into agreement to buy an asset at a certain future point of time for a certain price. A forward contract is traded on the over-the-counter market. Now here is the point that forward contract is traded in the OTC market, that is the network of the investment bankers or dealers and other financial intermediaries. What is long position and short position in the forward contract? So first, take one example that we have discussed earlier. Suppose two traders are getting into contract to buy or sell 100 ton of wheat after 3 months at the price of 500 rupees per ton. So this contract will be called forward contract. And the person who has agreed to buy the asset after 3 months, he will be called, he is long on the wheat, that is his position will be long. And the person who has agreed to sell the asset, he will be having short position. So long position is the person who has agreed to buy asset, and short position is the person who has agreed to sell the assets. Okay. Then coming to future contract. What is future contract? Future contract is nothing else, but it is a forward contract. But it is a forward contract. Then what? Why the difference of name? A forward contract that is taking place in OTC market is forward contract. A forward contract that is taking place on exchange is called future contracts. Why this difference of name? Because on exchange, the whatever trade it take place, that is very much highly regulated by the government. At the same time, exchange has its own terms and conditions. So these are the extended products that is in OTC market. The products that is being sold or bought is customized. That depends on the requirement of the individual investors and the discussion that take place between the investment bankers and others. This customized products and this standardized product will be more clear when we will be taking example further ahead. Right now, we should understand that in forward contracts are those contracts that is being traded in the OTC market, and same contract when get traded on the future in exchange market, then it is called future contract. So let us see the point on the slide. Very similar to forward contract. Unlike forward contract, future contract is traded on the exchange. To facilitate trading, the exchange specifies certain standardized features of the contract that we have talked about. That on exchange we will have a standardized product. This standardized product will be defined by the exchange. Exchange is a guarantee that no default will take place and contract will honored. Here in OTC market, where the forward contract is being traded, there can be default. Default risk is high there because the one of the party may do not wish to honor the contract. But in exchange, exchange take the guarantee that the contract will be honored. And thus default risk is less in case of future contract which is traded on the exchange. At the same time, in future contract, there is another feature that is margin money. Exchange take margin money from both the buyer and seller of the future product. Suppose a trader has agreed to buy 250 quantity of stocks of Reliance, 250 stocks of Reliance at the price of 2,500. Then the total contract price will be 6,25,000. Exchange will take around 20 to 30% of this 6,25,000. 10% will be how much? 62,500. So exchange would be taking somewhere around 1,50,000 rupees or something as a margin money from both buyer and seller both. So in case of default, there won't be any loss to the other party. Then in case of forward contract, the contract tenure will be also defined by the party. In case of future contract, expiration date or maturity date is always defined by the exchange. Mostly in case of Indian stock market, it is defined at last third day of the month. Last third day of the month will be the maturity date or expiration date for that month future contracts. So this is what is the forward contract and future contract. Let us see the difference between forward and future. Forward contract, private contract between two parties. We have talked about it is in a unstructured market and private contract between two parties. And then future contract traded on exchange. It is not private contract, but it is being traded publicly in exchange, and the exchange have all the records of the trade. Forward contracts not standardized, customized, as we have talked that forward contract structures and features will depend on the two party that is going into contract to buy and sell. But in case of future contract, standardized contract. Because here features of the contract is being decided by the stock exchange. And everyone had to trade within that features. Then in forward contract is settled at end of contract. Mostly forward contract is settled at the end of the contract. But future contract is settled daily. What does it mean? Suppose take a stock price for Reliance. Reliance is being traded at 2,500 in forward market, and two parties has got agreed to buy and sell at 2,500 after 3 months, and the quantity they have defined is 250. So this trade will actually take place after 3 months, and all the settlement process will take place after 3 months. But in case of future contract, same two party goes to buy 250 quantity of Reliance at the rate of 2,500. Then in this case, first NSE will take, National Stock Exchange will take, or any stock exchange will take margin money. That will be somewhere around 1,20,000 or 1,50,000. Contract value will be how much? 250 multiplied by 2,500, 6,25,000 will be the contract value. But margin money of 1,20,000 or 1,50,000 will be collected by the exchange from both the party. Now, suppose tomorrow the future price get increased to 2,700. Then the buyer of the contract is in profit of 200, and the seller of the contract is in loss of 200. So what exchange will do? Exchange will call for more margin from the seller of the contract because he is in loss, and exchange will pay some margin back to the buyer of the contract because he is in profit. So this way, this future contract is settled daily up to the maturity when the final exchange of stocks and current price will take place. Then forward contract delivery or final cash settlement. No, here is the point. What is cash settlement and what is delivery? In our example, we have the two traders has got into contract of buying and selling 250 Reliance, 250 number of stocks of Reliance at the price of 2,500. So after 3 months, the buyer will pay 2,500 multiplied by 250, that is 6,25,000 rupees to the seller, and seller will deliver that 250 Reliance stock to the buyer. Okay, so this is the delivery settlement. What is cash settlement? Suppose on that day of settlement, Reliance is being traded at 2,700. Then in the case of cash settlement, the buyer won't be paying entire amount of 6,25,000 to buy 2,500 that they have got in contract with for. No, in this case, what buyer will do? Buyer is in profit of 200 rupees. price has increased from 2,500 to 2,700. So buyer will pay only this additional profit amount of 200, buyer will receive in case of this, because seller is in loss. So seller will pay 200 multiplied by 2,500. That will be somewhere around 50,000 rupees to the buyer, and buyer will receiving that 50,000 rupees, and the contract will settle. So this is the cash settlement, where the difference of the contract, difference of the buying and selling, that is the profit and loss, is only exchanged in cash by both the party. Delivery do not take place. Then in forward contract, we have some credit risk. We have already discussed about it, that there can be default in case of forward contract, but in case of future contract, there is virtually no credit risk. Now let us talk about types of traders in the derivatives market. There are three kinds of traders in the derivatives market: hedgers, speculators, and arbitrageurs. Let's talk about hedgers first. Hedgers are those people who want to hedge their current position, that is the position that they have in cash asset. Suppose they are owning some asset, so they want to hedge that asset price from the future fall or future crash in the price. So hedgers want to hedge their risk. In case of our this Chicago example, where the farmers and traders were getting into contract, in that case, farmers were wanted to secure their customer. They wanted to hedge their position and minimize this, eliminate the risk of non-selling of the product in the future. So they were hedging their position. At the same time, traders wanted to secure supply. So they also wanted to get into position that they should be secured of such supply. There should not be any risk to the supply. So they were the hedgers. Then there are speculators. As we have discussed in our examples of Reliance, that contract value, when they have agreed to buy Reliance at 2,500, and the Reliance lot size is 250, the quantity that have to be exchanged is 250 quantity. So the total value of the contract will be 6,25,000. But the traders are getting into contract, buying and futures contract by paying only 1,20,000. So by paying only 1,50,000 margin money, they are able to get exposure to contract of 6,25,000. And they will be able to earn profit on the exposure of 6,25,000. So these derivatives products are also used by the speculators to get maximum exposure. Then third kind of traders are arbitrageurs. What is the view of arbitrager? Let us talk about what is arbitrage, in fact. See, arbitrageurs are those traders who buy and sell the products, any asset at one point of time in two different markets. What does it mean? Suppose Reliance is trading at 2,500 rupees on NSE, and Reliance is trading at 2,550 rupees on BSE. So on BSE, the Reliance is trading 50 rupees higher than NSE. So what arbitrager will do? They will buy Reliance or in the cheaper market, that is NSE, at the rate of 2,500, and they will sell Reliance at 2,550 rupees on BSE. So at the same time, they will sell in one market, that is NSE, and they will buy in another market, that is BSE, and they will earn 50 rupees. So arbitrageurs are those traders who buy and sell same product in different market at one point of time. So in case of future product, suppose future price of the Reliance should be 2,600 rupee, but it is trading at 2,000 and the current cash price is 2,500. On the basis of this current cash price 2,500, the future it is being traded at 2,600. But the future value should be only 2,570 rupees. So that is 30 rupees gap. So what arbitrager will do? They will buy cash. That is Reliance at 2,500, and same quantity they will sell in future market at the rate of 2,700. Okay, let us talk about future products in India. How many kinds of future products are available in India? One is equity index future. There are future products that are available on index level of any exchange. In the case of India, it is NSE and BSE. So on NSE and BSE, both the index futures are available. So that is equity index futures. At the same time, there is single stock futures. As per my information, 175 securities has been stipulated by Security and Exchange Board of India, that is SEBI, to be traded into the derivatives market. So we have available future products on these 175 securities, and this is single stock future. Either you can buy or sell Reliance future, or you can buy or sell Bharti Airtel. It depends on your decision. A part of its interest rate futures are available, commodity futures are available, currency futures are available. So there are 5 kinds of future products that are available in India right now. Interest rate futures, commodity futures, and currency futures we would be discussing in the next session. Then there are certain terminology that we need to understand, know the meaning of the terminology. One is closing out position, offsetting position, or squared up position. Suppose investor has agreed to buy Reliance in future, so he will get into, so he has bought the future of Reliance to buy 500 Reliance at 2,500 after 1 month. So that is long position. That is his long position in the Reliance. Now suppose after a couple of days or week he want to get out of that contract, he want to close his position. Then what he will do? He will sell 500 Reliance in future market again, because he has bought earlier. So when he will sell the 500 Reliance in future market again, then his position will close. That is called closing out position, offsetting position, or square up position. He is long in Reliance. When he will get short in Reliance, that he will agree to sell the Reliance in future market, then his position will get squared off. Then there is something called lot size. What is lot size? Lot size is defined by the exchange. In case of Reliance, the lot size of Reliance is 250. So any traders buying or selling in the future market can buy minimum, had to buy or sell minimum 250 quantity of Reliance shares, not less than that. And more than that will be only in multiple of 250, that is 500 shares of Reliance, 750 shares of Reliance, or 1000 shares of Reliance. And this lot size is defined by the exchange. the price of the stocks, like Reliance is having 2,500, 2,600, price is high, so lot size will be small. In case of Reliance, it is 250. Now, in case of Tata Steel price is somewhere around 110. So its lot size is 5,500. So we have seen most of the time that when the price of the stock is less, then lot size is high, and when the price of a stock is high, then lot size is less. This is probably because exchange want contracts value to be on the same level of the company which stocks is having higher price, something like Reliance 2,500, and a company like Tata Steel which is having price of 110 rupees, 20 rupees, their lot size will be high, so that contract value will be in same range of 5 lakhs, 6 lakhs, 7 lakhs. Then what is contract value or size? Contract value or size means the lot size multiplied by. In case of Tata Steel, lot size is 5,500. Suppose a buyer get into contract to buy one lot of Tata Steel at the price of 125. Then 125 multiplied by 5,500 lot size, the total amount will be 6,87,500. The 6,87,500 will be called contract value or contract size. Number of products. Number of products at one moment, 3 derivative products are available on all the assets on NSE and BSE. What is that? Suppose we want to get into buying or selling of Reliance in future market, then at one point of time we will have 3 future products available for Reliance stock. One future product will be maturing in current month. Another future product would be maturing in next month, and the third future product would be maturing in next to next month. Today we are in February 2023. If we go to buy or sell Reliance future in future market, then we will have 3 products available. One product that would be maturing in February month itself, that is 1 month future. Another product that will be maturing in month of March, that will call 2 month future, and another product that will be maturing in month of April, that will call 3 month future product. And all these 3 month future products would be maturing on last third day of that month. February month future products of the Reliance would be maturing on last third day of the February. That is 23rd. I think 23rd February is the last third day of the month. So it will be the February future product will be maturing on 23rd February. Then last third day of the March month is 30th March. So March month future product would be maturing on 30th March. That will be 2 month future. And third, April month last third day will be on 27th of April. So that April month future product would be maturing on last third day of the month. So at any point of time, we are having 3 derivative products available. One maturing in the current month, another maturing in the next month, and third would be maturing on the next to next month. And all these products mature on last third day of that particular month. Now, suppose the last third day of that particular month is holiday, national holiday. Then In that case, the future product will be maturing one working day prior to last Thursday. Then something called expiry date. As I have talked about, maturity date is called expiry date also. And that is always most of the time it is last Thursday of the month. If last Thursday of month is national holiday, then it would be maturing one working day earlier to the last Thursday of the month. Then there is something called spot price. A spot price is the same stock price in the cash market. It is a spot price is about current price in the cash market, that is also called a spot market. Then price limits. There are no day minimum or maximum price ranges applicable for future contracts. Future contracts price may increase or decrease to any extent that depend on the market conditions and the information available in the market. There is no price limit in future products, in future market. Then future products in India also include daily settlement, that is also called mark to market. Suppose a person, investor has gone long on future products of Reliance, and the price that he has gone long on is 2,500. Now, suppose next day Reliance closes at 2,700. Then the buyer is in profit of 200. So on that day, he will receive some amount of money from the exchange as a profit. Now suppose next day, the Reliance fall to 2,300. Then now he is in loss of 200. So at that time, he had to pay additional margin to the exchange. This kind of settlement is called mark to market settlement, and that takes place on daily basis with the buyer and seller both. Then role of clearing house. Of course, clearing house act as intermediary for collection of margin. Purpose of margin system. Purpose of margin system is to eliminate credit risk. Margin is taken only because tomorrow if the buyer or seller will dishonor the contract, then exchange will have some money to settle the contract. Then what is open interest? Any position in derivative market that has not been acquired of is open interest. Means a person has gone long on Reliance shares, Reliance future. If he has not acquired of his position by going short on Reliance future, then his position will be open, and that will call counted in open interest. If a person who has gone long on Reliance future, if he goes short on Reliance future, then his position will get squared off. Then his position won't be counted in the open interest. Of course, the going long and going short will be only in same quantity, that is same number of lot size. If the lot size is different, suppose a person has gone long on 5 lot of Reliance and he has gone short on 3 lot of Reliance, then his 3 lot of Reliance is squared off, and only the 2 lot that is remaining, that will be only counted in the open interest. So his open interest will be 2. Delivery versus cash settlement we have already discussed about. Then there is one concept, and not only concept, it also happens practically. Convergence of future price to a spot price. What happens that as the maturity date comes close, the future price and spot price both converge and at the time of maturity, that is the last moment of the last third day, the future price is almost equal to spot price. Almost will be a wrong word. It is indeed equal to spot price. Future price is equal to spot price. So difference of spot and future price get thinner and thinner when the maturity dates approach, and it's get eliminated at the time of maturity. This is the convergence of future price to spot price. If the convergence won't be there, then there is price disparity, and arbitrager will get active to earn a lot of profit in this scenario. So we are ending this session at this point. We will continue further in the next session. Thank you and bye.